I'm so excited to introduce two panelists who will help us unpack something very near and dear to Bloomberg's heart, which is data behind the demand for responsible investing. I have with me here Sophie L'Hélias, who is the head of LeaderXXchange, and Anna Snider, who's head of due diligence for wealth management at Bank of America. Welcome, both of you. I wanted to start off by just looking at what role do you think that demographics play in the prevalence of responsible investing and the explosion of interest in it today? Sophie, do you want to start us off?
Yeah, so, I mean, we're all seeing a major shift in generational trends, and so the generation trend, particularly the millennials, are focused much more on values and want to align their investment portfolios with values. And as these young generations are increasing their wealth, we're seeing a massive shift. In fact, this morning, I think CNN just reported an article with BlackRock saying they're seeing that major shift in terms of the products and services. So I think that's one part. And then as we're seeing the shift in the millennials, we're also seeing other demographic shifts, whether it's in terms of where that money is going and where it's coming from globally, not just in certain markets, and also in terms of gender. So all of that is playing into, I think, in this major transformation of financial services, but also in terms of what companies are expected to do.
So with more wealth in the hands of women and millennials, this is responsible investing is something that they're more interested in.
Well, they don't fall into the same traditional mindset, let's put it that way. And that's one part. And there's also, I mean, overall, a general framework that's happening or a trend in markets around the world. So in the US, it's particular, but in Europe, what we've seen is huge regulatory changes and policies that have focused on getting people to look at environmental issues and social issues. And that really fits with their mindset. You're seeing the same thing in Asia. If you look at the values in Asia in particular, long-termism is part of the culture there and the DNA. So as we're seeing the money coming from there, it's not surprising that we're seeing the investors looking from that from companies as well. So it's really not just the people, but it's the ecosystem that each of us, these people, are evolving in. And it's enormous. I think it's much bigger in Europe and Asia than in the US, but it's certainly coming to the United States.
Absolutely. Anna, anything to add?
Yeah, I would say I think a lot of focus is on the part of the industry surveys that talk about the demand in women and millennials. And certainly I think it has a lot to do with data, right? Which is that actually ESG data is available now to the consumer, the investor, and the consumer and the investor are obviously linked, especially when you're talking about women and the type of decisions women make in our society as consumers, right? And carry that over actually more than men do. But I think we need to focus on the other side of the equation, is that, at least in studies that we do, that at least the men will say, in baby boomer men will say, 49% of them actually will say that they're interested in potentially doing this. But if you think about how a lot of us, right, in traditional finance were taught, right, we were taught that you give you make your money over here, and you make your money however you make your money, and then you give it away here. U.S. baby boomers, right, a lot of it, men generated wealth, right, which is transferring to women, which is also important right now from a demographic standpoint. But men, right, have been, and the baby boomer generation has been the most philanthropic generation in the world, right? So I would say that the US translates this into a philanthropic, but what we're trying to do is actually bring two things together, which is say, you can actually, in this case, invest for market rate returns and something that looks like a market risk and return profile, but also incorporate some of your values. Not everything, right? It's not going to replace philanthropy, but it's certainly a way that you can bring your values or bring your interests in this area from your philanthropic portfolio right into your market-based portfolio. And I think that's important when you're thinking about this. It's not, focus on women and millennials as well, but also focus on currently who has actually a lot of the wealth. The demographics of a wealth management firm are the advisor is 60-something year-old male, so is the client, right, in the wealth management industry in general. So, that having that conversation, right, is actually really important as well, so not just to leave out that. Yeah.
So don't pigeonhole it as just women and millennials
right.
question.
They're not, they certainly are from a generation that absolutely cared about social and environmental causes. It's just that when they were taught about investing, they were taught in a very different way than what you can do now with ESG or sustainable investing.
Sure.
Yeah.
How about when we talk about responsible investing, what are the best measurements to use when judging whether a company is actually qualified as a sustainable investment?
So that's a really tough one. So going back to what you were just saying is in terms of the data, so one is we're seeing lots of data. Two, we're not necessarily seeing, not every data point is quality data. And as we're getting the new data, we're getting better academic research to tell us which criteria are probably have more impact. And the big issue we have is back testing when it comes to new investment products because we don't necessarily have data that goes back 15 years. So I think one of the things I'm worried about, to answer your question indirectly and then maybe more directly, indirectly, is that just because you have a bunch of ESG criteria, you dump them all in together, doesn't mean you're going to get an ESG product. And that's what I worry about because there's a lot of thoughtfulness that goes behind that, and it's relatively new in terms of understanding where that data is coming from and what it really means. One area I think is that we're seeing is different lenses. So we developed a product on gender particularly, and the idea behind the product was to think about, and the methodology was to think about a narrative. What is your narrative behind that ESG product? So us was gender, it was do intentions meet the outcomes, and our company's transparent, pretty simple. And instead of 25 or 30 indicators or 40 indicators, we brought it down to 7. Why? Because these were very easy data sets to compile, that we could back test them, and that we had enough quantitative research. So I think that's really the big issue. Going forward, artificial intelligence will make it better. And
how will it make it better?
Because we'll be able to run some algorithms probably, and also collecting the data and the comparability in terms of global markets. So if you're doing a global ESG, if it's global developed markets versus emerging markets, and that's really where I'm seeing a lot of push on the developed, and then some demand from the emerging.
Yeah, Anna, anything else?
Yeah, I think a lot of work has been done on what I would call data aggregation in the ESG space. So there are a lot of providers, right, that collect now lots of data that, and then there are firms who are running, sustainability strategies that are also collecting data, maybe combining them, maybe just using proprietary views on what ESG is. And that is great, and that's actually what's enabled this to become more, quote unquote, mainstream, right? Which is that you have at least sets of data now that people can use. They can use it in investment decision making, they can use it in portfolio construction or risk management. I think the thing that's missing though, which is actually really important to clients, whether you're institutional or retail, and what I always say to sustainability managers is it's great that you have all this data that you're using to make the initial investment decision, but what about the outcome? Now that is actually a harder set of data that it is still, all of this data, by the way, is in progress, right? So, it's hard to scrub and compare certain sets of data. Everyone's using different data sets. They differ wildly in sort of their opinion or rating about a particular company, and et cetera. So you sort of just use, you know all of that and you use it just to inform your investment decision-making process. But this outcome, right, so what are you trying to do with a sustainability strategy, right? Assuming that you're not just doing this as some marketing thing and to check the box, right, and say, oh, I did that, let's carry on, get to the real investing, right? Basically, it's the ability to say, what am I trying to do? What outcome, what does this ESG profile look like? What are outcomes that I'm trying to achieve? And be able to define that. And right now, that really for a lot of people is actually just still sits in both a quantitative but also a qualitative, right, set of objectives that a sustainability strategy can have. And I will tell you this, it's really, really important to clients to actually know that they've done all this work, you've gone down this path, you've selected all these ESG strategies, and at the end of the day, what they want to know is that their capital is actually doing what they wanted to do. And that's actually the part that I think is still really in development with asset managers in the investment community, which is trying to figure out how to express what the outcomes are.
So while we're doing some work on there's a lot of attention paid to which data points, like, you know, what is a responsible investment. But where we still need to move is how do we quantify whether that was a good, sustainable investment and the outcome was what we wanted.
Yeah, absolutely.
Okay, and I'm curious how you each ended up in this world. Can you give us a bit of backstory on that? Maybe Anna, you want to start on that?
Sure. Well, I decided to become the black sheep of my family and go into finance, which I know sounds very strange to many people, but my dad was a minister and my mother was an inner school city teacher. So I had basically anti-apartheid bishops and coming through for dinner and lots of foster children and immigrants that we were helping sort of on a consistent basis. And so when I decided to go into the world of Wall Street, my family was not so psyched. But I, of course, considered, I still did my philanthropic work on the side. And it was about 6 years ago when Bank of America was thinking about how we took, at that time, our environmental commitment and pulled it through into the wealth management and tried to see if our clients were interested in incorporating environmental but also social issues into their investment portfolios, that I sort of jumped up and raised my hand and said, wow, this is like the absolute sort of perfect marriage between my upbringing, but also my philanthropic interests at the time. I was doing a lot of work in microfinance and my day job, and I think that that combination, it's a really rare thing to find where you can bring that together. But you know, in this case, I did. So.
Yeah, a great combination. Yeah. Sophie, how about you? How did you find your way to responsible investing?
I was in the governance space. I used to be a managing director of an activist hedge fund, and we would target underperforming companies, mostly in Europe, on corporate governance. And I also co-founded an international corporate governance network, which was a group of investors really trying to get best practice. So the shift from governance to environmental social is actually what we're seeing in a lot of the asset management teams, governance teams, and then the environmental social converging. So that was one. And then progressively, as I would see a lot of the issues, because when you're doing shareholder activism, it's all about narrative. It's trying to get your narrative out to the market adopting your narrative, obviously with some numbers, and then pushing that change if the market supports it. In governance, and particularly gender, I think it was accidental. So in the gender space, it started when France adopted quotas. I mean, I read about it, about Norway, and France adopted quotas. I happened to be a French citizen, and I got a call, and someone asked me if I would join a board because they were looking for women. And that got me to think about, well, you know, what's behind all of this, and I started reading a lot of academic research. Fast forward, I thought, what if we did what we did with shareholder activism? What if we used certain models, the governance models, applied to gender? And that's how I got into that space. And really talking to companies, investors, board members. I also do serve on public boards, and our board just got the award of the largest number of women in Europe. We have 64% women on our board. So, I will join a board where they really believe in what they say.
One thing I wanted to ask you, Sophie, is you consult with companies that are both large or startups. What are some of the differences between how these companies are approaching sustainable investing or positioning themselves as sustainable investments?
Okay, so on the corporate side, I think it's really challenging. It's very challenging, and I think going to what you were saying earlier, because it's all over the place. And so very large corporations have resources, but they don't necessarily know how to allocate those resources to collect the data. And I would say even more importantly, what investors are looking for. So I think the conversation and dialogue between investors and companies is really important. Then you go to the board level, which is where I serve, and on the board level, you got to get the directors to be on board to understand that ESG is really to be incorporated in the strategy and develop some KPIs so that you're actually talking to the management at the decision-making level on these issues as opposed to some sustainability division. On the small corporations, it's actually easier in some respects because they're so small and nimble, and usually you'll have the founder or certain members of the team that are so part of it, so you're not disrupting a culture. They're actually very, very, very nimble. So I think on that side. On the investor side, very large organizations that have a traditional for governance, and I would say, or environmental social issues, they've been on the bandwagon. As you were mentioning apartheid, if you look back, I mean, that's really when it all started in the US. It's really the continuum of that. The smaller investors, but are a little bit more nimble, don't need the same resources, and can just pick up a bunch of data sets. And if they have a track record in terms of investing, they can do quant or they can actually do fundamental analysis. So I think this is a huge opportunity, but the larger institutions are probably a bit slower to get it just because they're just slower to move. But when they do it, they do it well.
Anna, sitting within a large institution, what are your thoughts on that?
Yeah, so I think, obviously I sit on the wealth management side, and then we have a separate organization that does the ESG on the corporate side for Bank of America. So I won't speak necessarily for them, but I think it's funny because I always hear from smaller companies that the cost structure of doing getting all of the requests from different investors and setting up this whole sort of ESG or a sustainability program is really a cost, high cost, but at the same time you're getting demand from both institutional and retail clients. And I agree, there's so much data and there are so many, frameworks for how you can measure and so many guides and tools and everything out there that I don't think that's, when you had to make it all up like 10 years ago, maybe it was a really big cost burden for small cap, companies, or let's say, or smaller companies. But, but I think that argument is not as strong anymore. And I think a lot of the large companies have very established groups that do this. I will say though, there's a lot of discussion that happens around whether a lot of this information is going to be subject to regulatory disclosure. I'm not necessarily. I don't have an opinion about it either way. I think that's a long road potentially to get to where you have regulatory, but it'll be interesting because then that does become a regulatory cost rather than just sort of responding to demand. So that may shift the economics of trying to do sustainability a little bit, but in the U.S. anyway, obviously in Europe, it's already there.
Right,
yeah.
We're already incorporated.
Yeah.
Which is why I think a lot of European companies have that competitive advantage. Yeah. Because they can actually position that. I think a big trend is going to be integrated reporting. I think that's something that we're seeing more of, and frameworks like SASB that we were talking about earlier in the green room, just really providing companies with some structural frameworks that they can work with. So I'm pretty optimistic on how that's moving.
Yeah. One more question for you both before we open it up to questions from the audience. One criticism that periodically comes up around this space is investors who say, I don't want to focus on anything except returns. And what would your response be to that? And how would you incorporate data into that discussion? Sophie, you want to kick that off?
I mean, it has to be about returns. And that's really, if you talk to asset owners, we were meeting with the CalPERS board in July, and they're really looking at gender investing as well. And their job is to make sure that they have enough money to pay the pensions. So it has to be about returns. What I think is really good now is that we're seeing data and we're seeing academic research that shows that you can do good and do well. And I think that's really what it is. What we don't have, and I think this is where you have some people still on the fence, is the issue of back testing and sometimes on the quality of the data. But today there is sufficient evidence, whether it's in the quant funds or other index funds or other types of funds, you can actually, you're not compromising your returns. And yet you can still focus on investing in a way that makes you happy about the way you're investing, because that's really what it comes down to.
Anna, what's your response to that?
I think that question comes from people who still think that this is mostly an exclusionary-based investment approach. And there certainly are clients that, because of their mission or their mandate or whatever it is, have to exclude certain things, whether it's their beliefs or their, a mandate that they have. And so but this is not, this space has evolved into what is an economic argument, right? And what, by the way, investors have been doing forever, which is looking for sustainable companies. So somehow sustainable has become ESG, but sustainability in management teams and high quality management teams are actually what investors have always looked at, particularly fundamental investors have always looked at.
G in ESG.
Well, even they may not call it ESG, but they're looking at these issues, right? They're understanding that there are actual risks to their investment thesis, but they had no data. There was not an industry that was called this. So I normally just say to people, listen, sustainability or ESG data, right, is just additional data that you can invest with. And what investor in the entire world does not want additional data to help make their investment decision? You're not throwing out what you've learned. You're still using financial analysis. You're still determining whether the company holistically is at a good price to invest in. You are just using additional data either to say, is there a risk to my thesis, or actually does this make this company more competitive? So I don't get this sort of I get it, because a lot of the early strategies maybe did have a trade-off, right? That you took a bunch of stocks out, you maybe didn't even re-optimize the portfolio, so you had a non-market-based portfolio that you were trying to, sort of outperform with. So I get that's how it used to be, but this is not what we're talking about. We're talking about a different type of investment approach, and so I think that question is, but there needs to be a proof statement, right, to your, whether it's back testing or a track record. The proof statement, especially for U.S. investors, is still right out there, and it is still to be proved, I think, in a lot of people's minds. So it's a time element.
Last point before we open it up.
I think you made the real is all about the innovation side. So you have the risk management, but the innovation. And I see it within corporations. If companies are looking at ESG, they're actually seeing this as a tool for innovation. And talent management. So the long-termism is you're attracting people, you're developing a new culture, you're more diverse, and that's creating a lot of positives. And on the negative, companies that don't do that and have really bad actions and bad outcomes, well, you see those outcomes, and we saw them recently in Silicon Valley, and not just in Silicon Valley, but also in financial services industries. Were really bad cultures. So these are also both opportunities to attract the right people and create the right culture, and risk, because your company can crash.
Absolutely. Okay, I could go on all day, but I want to give our audience a chance to ask some questions. So Lauren.
Thank you, Annie. Hi, everyone. I'm Lauren Keel. I'm going to be here asking your questions for the rest of the day. Just as a reminder, if you have any questions for our speakers, please submit them via the app. Again, that's grif2018.app. While you guys are pulling that out, I know we've got a lot of people standing around the back, so if you have a seat next to you that's available, would you please raise your hand? I know there's a bunch up here in the front. Everybody in the back, come on up. There's a lot of open seats.
We don't bite.
Come in. Come sit close to the stage. Okay, let's take a couple of questions. Thanks, Annie.
Okay, great.
What are the barriers you see to wealth management organizations broadly integrating ESG data into their capital markets assumptions, and subsequently to integrated advice and guidance?
That's a great question, and one I've never been asked before, which is not common. So into their capital markets assumptions, essentially, I think that a lot of the quants, in our organization anyway, that create the capital markets assumptions do not, are still in this phase where they are looking at, these quants look at very, very long data sets, right? And to incorporate something, as any quant in the room knows, you have to have a very, very specific set of factors that you think actually cause a change. I think that is part of the proof statement. That is that is still happening in the industry, and I think that's why they're not yet integrated.
There was a mention of clients wanting to know that their outcomes are meeting their objectives. But have you found that clients themselves can properly articulate what their objectives are with ESG investments?
That's interesting.
That's a really good question.
No.
Yeah.
I mean, it's sort of like, I don't know, maybe this is too personal, but it's sort of like finding a mate. Like, you're pretty sure you know what you don't want, right, in someone. But it's very hard to articulate what you do want necessarily. And you can say that, these things that you read about, or these things, make it look maybe this is just maybe as someone who used to date New York City a lot, right? Maybe maybe you can say, this is, here are characteristics that I like, or but they don't often have like the full set of, here's exactly what I'm interested in, and I know that these types of strategies that exist. And remember that the financial advisors also most of them anyway that I deal with are in a learning mode around this, and so they may not know like, hey, there's a solution that fits for you. And there are a lot of different ways to approach this, and so I don't think, I think that it's an education for both. And where I've seen it be actually most successful is when the client says, I know I'm interested in this, but I need some help in figuring out what I want to do. And the advisor says, you know what, I know that I'm supposed to be the financial and the investment expert in the room, but I'm going to be a little bit vulnerable, right? And I'm going to go down this path with you, right? And we're going to learn together and figure out how this looks. That is where I've seen things be the most successful, right? Rather than this like, I don't know about it, but I'm supposed to be the expert, and so I don't really want to talk about it. Can we just put one ESG solution in and then move on to something else, right? So be a little bit vulnerable and go on the journey because it's worth it.
And I would, going to that, I would separate impact investing and the responsible investing. And so the person who really wants to have an impact is probably somebody who's going to have a more articulated view of what it is they want and what they want back, going back to the return. And then the other investor might be into more in the lens type investing. And so they're like, listen, we really want to drive this kind of change. We want to be part of this kind of journey, and your product seems to bring me there. So you have more structured products that would work for them. So I really think it's already two mindsets, and based on that, you're going to have already a different conversation.
Sure. Well, it pains me, but I have to close it off there. But thank you both so much for all your insights. Thank you. Thanks all.